Welcome to another edition of Focus on Alternatives, sponsored by ADISA, the Alternative and Direct Investment Securities Association. My name is Greg Moz. I'll be your host today. And we have Rob Kaplan with Kaplan Vogler. He's an attorney who's been working on Reg A deals for many years. And so we want to have a conversation. But to get us started, can you define Reg A Plus, and kind of level the playing field there for us?
Sure. So Regulation A Plus really refers to revisions that were made to Regulation A, which has been on the books with the SEC since the 1930s as a result of the Jobs Act of 2012. It created two tiers of Regulation A type offerings. Tier 1 is the closest to the original Regulation A offering class, and Tier 2 is where we really saw the radical changes. So Tier 1 now has a $20 million offering cap as opposed to the old $5 million offering cap. However, it is still subject to state blue sky. It doesn't have the reporting requirements of Tier 2, but you do have to go through the state process, and you don't have to have qualified purchasers, but it tends to be a bit more laborious because of the state regulatory regime that you need to work within. And it also does not have the transparency of Tier 2. Tier 2 is what people commonly refer to as Reg A Plus, and is really where we're seeing the breadth of the new securities transactional activity that's going on in Regulation A. So in Tier 2, the cap is currently $50 million in a trailing 12-month period. You are exempt from state securities processes, which make it a lot more feasible to get your deals done within a reasonable period of time from the standpoint of registration with the SEC and the legal work that needs to be done. There's also an exemption from the traditional, what we call as lawyers, Rule 12G, which is a requirement that issuers who have a certain number of investors and have a certain number of assets within their capital stack must register under the Securities Exchange Act in 1934 and become a reporting company. Tier 2 Act has an exemption from that as long as you're using an appropriately registered transfer agent and you meet what is essentially the small public issuer definition under SEC regulations. So from the standpoint of the activity we see in the space, it's typically going to be that Tier 2 because you're dealing with a size that's meaningful for the distribution networks to work with. It's a streamlined process. The reporting process or requirements of Tier 2 allow for the transparency that the distribution networks want to see when they're assessing those deals and those issuers.
So the transparency is good for investors. The higher dollar amount is good for sponsors that are trying to raise money. How is this Reg A structure different from the other types of alternative investments that broker-dealers and RIAs are used to dealing with?
It's really, what I tell people all the time is keep in mind that Regulation A only deals with the method of offering the securities. So much like Reg D, what we're dealing with is an exempt securities offering type. Now, a little different from Reg D from the standpoint of a Regulation A security itself is exempted from the registration requirements of the Securities and Exchange Commission. But it really relates to how the securities get pushed into the marketplace. So you're going to see a lot of structures that actually broker-dealers, registered investment advisors within the alternative space have seen quite often. Fund structures, REIT structures, bond structures. It's really just how they're offered in the regulatory scheme of how those get into the marketplace and who can invest that's different.
Mm-hmm. So the Regulation A Plus is kind of newer to the marketplace. How is the adoption coming along? What's the deal flow like these days?
Sure. To be perfectly honest, we were a little surprised at how slowly the offering type was being adopted in independent broker-dealer channels and in the alternative space. And I think that was a result of just, people needed to work up the learning channel on this. I think there was some inconsistent messaging that came out from state regulators as well as FINRA and the feds originally that caused some confusion in the industry. But fortunately, we've seen quite an uptick in the number of deals that are being done and the success that issuers are having in getting their deals done within the space. I think in the traditional ADISA style IBD RIA community, you're typically seeing current yield product that is what's being picked up in that space. So bonds or REIT structures that have a preferred dividend associated with them. Broker dealers who have a history of working with what I would call micro-cap public companies and what have you, and the new portals that are allowed with the marketing that has been permitted in crowdfunding and Regulation A under the Jobs Act, tend to be more focused on those what I would call a value add deal. So maybe there's not a big yield component to it today, but really what they're playing to is an opportunity in a security that has the opportunity to double, triple, quadruple in value when it reaches a listed market. Beyond that, we've also noticed some interesting developments regulatorily. The SEC is looking at, as well as Congress, raising the raise amount for Tier 2 from 50 million to 75 million. And regulations have changed, which will allow now 34 Act registered companies that have securities listed on exchange to use Reg A for future capital offerings. So that's a positive step that I think will attract more trading houses and broker dealers to the space. And then finally, we have noticed that some of these securities are now being picked up by alternative trading platforms such as Ameritrade, Schwab, Pershing, to be traded as CUSIP and DTC qualified securities on their platform. So very, very encouraging to us that we're seeing the marketplace, while still definitely smaller than Reg D, it is growing and it's maturing to reach a number of different sophistication levels within the securities marketplace.
Sounds like there's a lot going on. So our audience is mostly broker-dealers, reps, RIAs. If they're looking at integrating a Reg A offering into a client's portfolio, what are some of the things they should be thinking about?
Yeah, so I think some of the things that they need to understand moving into the marketplace is most of the issuers that we're seeing right now are really what I would call capital-driven as opposed to fee-driven. They are looking at a long-term capital structure, or capital strategy to grow a core business that they have. And so as a result, they're not focused on fees deriving from the investment structure. You're not going to see a lot of single project or single asset type syndication structures right now in the Reg A space. But I also think that's a positive because the management teams associated with these things have a big picture and they're very goal driven, which is aligning from a management perspective and an investor perspective at the end of the day. I do think they need to be sensitive to, because Reg A does allow an issuer to cast a very broad net when it comes to investors. There are a lot of people who misunderstand the use of it, and so you'll see a lot of startups in there. So they need to be sensitive to what kind of company, at what kind of growth milestone are they at when they go to the Reg A format. I think they really want to look for companies that are at a growth stage or have a history of established revenue with a very defined long-term capital strategy. I guess some of the other things I would say about it is it's very interesting. We're seeing a very diverse range of industry sectors associated with the securities. You don't have to have accredited investors for Tier 2. Right. You deal with what's called qualified purchasers, meaning they can either meet the accredited investor definition or they merely represent to the issuer that their investment is less than the greater of 10% of their stated net worth or their annual income. So you can reach a much broader investor base with these securities. The 12G exemption that I talked about a little while ago means that you can deal with much smaller and typically see much smaller minimum investments with these securities. So you have the opportunity to expand your client base, but also create some diversification for your clientele if they're looking to explore the alternatives market, or perhaps they've spent some time in real estate but they'd like to go look at energy now, or some life science. So it allows the financial advisor to work with that client to experiment, explore, but minimize risk associated. And then finally, I think the other thing they must keep in mind right now when they're looking at these securities is while Reg A does permit for the trading of the securities, so they're not restricted securities like Regulation D, there really hasn't been, as of yet, an established secondary market to develop for these securities. I think there's still some things that SEC needs to do to foster that process, but I think the OTC can take these securities. There are some other alternative trading systems, but it's just not there yet. So I think the financial advisor needs to soberly look at this with their client and understand that these are, in essence, a non-traded security at this point, and you're going to be holding this security for quite a while.
So when you talk about non-traded securities, what are the different redemption options, or how do you liquidate these securities if trading out of them really isn't developed yet?
Sure. So I think, again, I harken back to the comment I made before. Most of the structures you're going to see in Reg A are not going to be unfamiliar to RIAs and BDs that operate in the alternative space. So, for instance, bond offerings will have a maturity associated with them, and so the issuer will repay the principal of the bonds at that maturity date. That's one example. Other types of issuers, REITs or fund structures or company structures, could have share redemption programs associated with them, not dissimilar from what they have seen in Reg D and publicly registered non-traded securities. So a certain percentage of securities could be redeemed in any given year, and there's usually discounts associated for the sooner you use the redemption as opposed to later. But really the same things you'll see in any other context.
Great. Well, Rob, thank you so much for kind of walking us through a complete overview on Reg A and how they apply to investors. And thank you for watching another edition of Focus on Alternatives. For more information about Reg A or other alternative investments, please visit adisa.org. Thank you.